let's bring in Jeff Palma. He's over at UBS. And Jeff, I want to talk to you because we did see quite a run-up in the equity markets last week. Strong gains, two-day rally. Do you think it can continue?
Well, I think it probably can, at least for the time being. We've seen a couple of very positive things come through. Of course, earnings news in the U.S. has been quite strong. The bank stress tests, we can talk a little bit about just how stressful they were, but at least there weren't any negative surprises associated with that. And on our measures, we're seeing a little bit of an increase in risk appetite over the last few weeks, and that seems to be boosting things as well.
Jeff, let's talk about those European stress tests because, I feel like there's a lot of Monday morning quarterbacking going on. Say, were they that transparent? Were they that tough? Were they, in your view, and should we really trust them at this point?
Well, I don't think they were probably as stressful as people would have liked them to be, or as tough as we would have liked them to be. By all accounts, the amount of capital that's being suggested is required is way less than we believe is likely. But on the flip side, there's a couple of things that are pretty clear. Number one, that the regulators are working with the banks, not against them. There were no negative surprises about heavy dilution that's going to come through. And there was probably some transparency that was given by the process. And so we're probably not out of the woods, and not everything is kind of a full green light for the European banks,
right?
But it's maybe not as bad as it could have been.
But my understanding that those European tests ignored the majority of banks' holdings of sovereign debt. To me, that just doesn't make any sense because that's what we're all worried about.
Agreed, right? And that's why we're not quite out of it. If there's a problem on the sovereign debt side for Europe over the course of the next couple of months, before banks are really able to significantly add to their capital base, there is still a liquidity and a funding problem for the European banks. I think now the onus is on the banks to get this done on their own rather than having it forced upon them from a capitalization perspective.
All right, let's talk about something you mentioned earlier, Jeff, and that was the risk appetite, because I've talked to a lot of folks who said right now investors, you name it, they're risk averse. You think, though, investors are willing to take on a little bit more risk at this point?
I agree completely that investors are risk averse. I mean, the clients that we've seen over the last month or so universally are more concerned about downside risks than upside. We have an equity risk indicator that we track here on a daily basis. That's been firmly in negative territory now, really since the middle of April. So for the better part of 2 months, which is the longest time since March of 2009 that we've been in negative territory. We're seeing that indicator just gradually move up towards a more neutral level, maybe turn very slightly positive at the moment. And it suggests that at the margin, as good news comes in, that maybe people are willing to re-engage a little bit.
Well, that's interesting. We've also been tracking that institutional investors are moving more so into equity at this point, but not the retail investors. We're seeing that diversion, if you will. What does that say to you?
Well, I think from an institutional side, it's about relative value for equities. Bond yields, treasury yields below 3%, credit spreads very, very tight. I think from an asset allocation perspective, it's maybe not surprising to see people are finding a little bit of value on equities, especially when on a global basis, PE multiples are, call it 12 times, right? So pretty attractive.
Right.
I think retail is still just very nervous and really scarred in some ways from where we've been over the last couple of years. That's about risk aversion, and maybe there's an element of permanent risk aversion in there, or at least for a while.